James, good to see you again. You know, when you look at what's been happening in the market over the past few days on a technical basis, some say that it is sort of deteriorating so quickly that the bulls are starting to think about becoming bears. What can you tell us in terms of historical perspective? What happens next in a scenario like this?
Well, hi, Alexis. Well, geopolitical situations are always very, very challenging. Obviously, there's humanitarian and regional implications even beyond the market. And the challenge is that there are just such a wide-ranging set of outcomes, and it's incredibly hard to do the calculus and predict exactly which one will take place. So that's the bad news. And of course, the market has reacted accordingly. The S&P is close to 11% down from the all-time high in January. But when you look at history, and again, history is not a perfect guide to this, but it's the best we have. It is generally not the case that these have long-lasting impacts for the economy and also for the markets under certain conditions. So if you look at the last 20 years, even the closest sort of analogy to this current situation with Russia annexing Crimea in 2014, it was not the case that you had a severe market reaction there, and not just for U.S. stocks, but for energy prices as well. And in fact, yet the market bounced back from the initial shock very quickly in that situation. So across all these historical examples, you can go through the Arab Spring, go through the wars in Iraq and Afghanistan, even last year's exit from Afghanistan that caused a lot of some volatility. What you see is that really it's the underlying economic growth situation that actually matters more, the underlying business cycle, once you get past the several days or the weeks after that initial shock. So our underlying suggestion is still to hold on to your investment portfolio. This is not the time to, get cold feet and, get out of the market per se, because when the market does turn around in all of these historical examples, it could turn around quickly and without warning.
So on a technical basis, when you look at the S&P 500 below its 200-day moving average here the past few days, that's usually a bearish sign, right? That a bigger slide is in the offing. And some are saying that the support level was around 4,300. The S&P is just below that right now. So I guess, is the index sort of living on the edge of support right now?
Well, I think the challenge here is that all the technical levels are based on the geopolitical events that are happening right now. In other words, it's based on the fundamental activity that's happening in the Russia-Ukraine conflict. But also, let's not forget, the Fed is a big storyline that's here with us, and the Fed liftoff that could take place next month. And so we think that's really the key driver. The technicals are kind of playing off that. And again, when you look at history, what you see is that it's better to not overreact to these types of events. Although there are, of course, situations where the market could deteriorate further, it's generally the case when you look at these examples that it was often better just to stay invested throughout these periods. Especially, in this case, we're talking about a situation where there are still diplomatic channels open between the U.S., NATO allies, and Russia. And so as long as that's the case, we think that there is still the possibility that markets could be all right in this period.
You mentioned the Fed and liftoff next month on those interest rates. Do you think that the situation between Russia and Ukraine might change the Fed's timeline on when it will begin to raise those rates? And is raising rates now the prudent thing to do?
Yeah, it's a great question, Alexis. Obviously, there's lots of intertwined headlines and events happening at the same time. We don't think it changes the Fed's timeline per se. In other words, next month is probably the right time for them to start raising rates. We think there's a high likelihood they do that. That's what the Fed funds futures market is saying as well. However, the question is it 25 basis points or 50? And that's where we do think the headlines and the geopolitical risk that's at play today could change that calculus. It could tip it closer to a 25 basis point rate hike when before maybe it was a coin toss. And so we don't think it changes the overall outcome of the Fed trajectory. Right now, Fed funds futures are still saying about 6 rate hikes over the course of the rest of this year, which is generally about one every meeting. We don't think that changes. And part of that is because inflation is still quite high. And if with energy prices rising, the double-edged sword is that actually increases inflation as well, at least that inflation felt by consumers. And then the other aspect of it also is that with the economy doing so well, even without inflation, the Fed could justifiably raise rates. Think about where the Fed funds rate was at even before the pandemic. It was at 2.25 at its highest point before it came down. And if you think about us being back at pre-pandemic levels, further rate hikes, not just in March, but later on in the year, are more likely justified.
And in about 30 seconds or less, James, give me two actionable ideas for investors at the moment willing to still put some money to work in this market with all the uncertainty.
Yeah, we think that in general, high level, stay invested. Let's not try to be cute and trade in and out of this market, because the market can turn around to the upside fairly quickly based on history. And the second is, it's really about those secular sectors in the market rather than, pandemic related sectors. Those secular sectors should do well as the economy continues to rise and as the Fed raises rates.